Welcome to the September edition of State of the Market. A weak second half of August pushes stocks and bonds lower. After coming off a strong July, stocks could not continue that momentum through August under the pressure of rising interest rates. Stocks started the month off strong, completing close to a 50% retracement from the low point reached by the S&P 500 in mid-June. However, the second half of August proved challenging, and stocks dropped from that point to close the month in negative territory. Likewise, the VIX index made a rather steady move, higher from the midpoint of the month, going from below 20 to end August at 25.87. Ongoing concerns of elevated inflation and the Fed's aggressive response of raising interest rates continued to weigh on the market and create a more volatile period for stocks during the month. Some highlights from last month. Market strength from July failed to continue through August as stocks and bonds declined during the month. Bonds rallied in July, but the 10-year U.S. Treasury yield rose in August. After ending July at 2.67%, the yield closed August at 3.15%, which created a challenging environment for bonds. No Federal Open Market Committee meeting was held in August, but the annual meeting of central bankers in Jackson Hole was consequential. Chairman Powell's keynote speech reinforced his current hawkish stance, and stocks tumbled. Slower growth is impacting the economy, with the Fed poised to continue to hike rates. We don't believe we are in a recession currently, but the odds of a mild recession next year have increased. What are the associated risks with the increased rate environment? Purchasing power. Increased interest rate means higher monthly payment. Higher monthly payment lowers your qualifying ability to borrow. A mortgage at a rate of 3% versus 5% is an $800 difference at a $500,000 loan. Variable interest rates, increased risk to the borrower, impacts to revolving credit, those being lines of credit, credit cards, and home equity lines of credit. There's market value fluctuations. Interest rates and price are inversely related. It's like a seesaw. Rates increase, price normally decreases. Inflation is keeping prices high. Concerns on the horizon could be potential hyperinflation, although not likely. In June, a 75 basis point rate hike from the Federal Reserve was seen as surprising acceleration from a 50 basis point and 25 basis point delivered at the two previous meetings. Less than 3 months later, 75 basis points has become something of a global norm, with both the European Central Bank and Bank of Canada set to raise interest rates by 75 basis points, Citigroup economist Andrew Hollenhorst says. In 2022, the Fed has raised rates 4 times, as an increase of 2.25%. The increase includes the 275 bips increase in June and July. Another speaker, Cleveland Fed President Loretta Mester, repeated her assertion that Fed funds rates, currently pegged in a range between 2.25 and 2.5, should rise above 4% by next year and stay elevated until inflation comes down. In my view, it is far too soon to conclude that inflation has peaked, let alone that it is on a sustainable downward path to 2%, Mester said. If any of these highlights are a concern for you, consider working with Huskey Financial to create a well-balanced plan that can guide you through the current tumultuous periods and make some decisions that will give you the best chance to succeed in working years and in retirement years. Contact us today for a brief 30-minute consultation where we can determine if we are the best fit to guide you moving forward. Thanks for watching.